All right, let's get straight into it. When Australia's Q3 inflation numbers dropped, the financial world just about lost its mind. All that talk about interest rate cuts, poof, gone. The big banks started scrambling, and property buyers everywhere were left wondering, what on earth is going on, and what does this mean for house prices? So in this explainer, we're going to break it all down. First, we'll look at that inflation shock that caught everyone by surprise. Then we'll see the wild U-turn the big banks had to pull. We're going to bust a huge myth about rates and house prices before unpacking the four forces that actually drive the market. And finally, we'll ask, could all this chaos actually be a window of opportunity? Okay, so let's jump right into the numbers that sent shockwaves through the entire system. This wasn't just a little blip on the radar. This was a result that completely rewrote the script for the next year. I'm sure you're thinking the same thing I was. Hang on, wasn't inflation meant to be under control? Weren't we all getting ready for rate cuts? How did we go from that to this, practically overnight? Well, this is the number that did it. 1.0%. That was the trimmed mean inflation for the third quarter. And just so you know, that's the RBA's favorite number to watch because it smooths out the really crazy price swings. Now, the market, everyone was expecting something like 0.6%. So 1.0% didn't just beat expectations, it absolutely blew them out of the water. And to give you some context here, the Reserve Bank governor herself had basically drawn a line in the sand. She'd warned that a result around 0.9% would be a material miss. Well, the actual number came in even hotter than that. It was a massive signal that this inflation fight was far from over. So, where did this come from? The biggest culprit by a long shot was electricity. It jumped a massive 9% in just 3 months. And this was almost entirely because the government's cost of living electricity rebates, well, they expired. As soon as that support ended, bills snapped right back up. And boy, did it show up in the data. So what happened next? The market did a complete 180. The reaction was immediate, it was brutal, and it left the big banks scrambling to completely tear up their old predictions. You can just see how quickly the mood changed. In early October, a rate cut in November was pretty much seen as a sure thing. Then, on October 28th, bam, the inflation data dropped. Within days, the odds of a cut just collapsed. And now? The market isn't expecting any rate cuts until well into 2026, a complete and total reversal. And here you can see it in black and white from the big four banks. The Commonwealth Bank went from expecting cuts to just saying, nope, the cycle's over. ANZ and NAB punted their forecasts for the next cut all the way out to 2026. And Westpac, they just threw their hands up and completely withdrew their prediction. That is a massive shift in thinking. Okay, so this brings us to a really important question. If rate cuts are off the table for ages, that must mean property prices have to stop rising or even fall, right? That's the conventional wisdom. But Australian property history, it tells a much more interesting story. You know, we're all taught this simple little formula. Rates go up, prices go down. Rates go down, prices go up. But the truth is, the Aussie property market has a long and proud history of just not following that script. There are other forces at play, and sometimes they're way more powerful. I mean, just look at this period between 2003 and 2008. The Reserve Bank was hiking interest rates like crazy, pushing them up 2.5%. By the book, prices should have taken a nosedive. Instead, they climbed by 32%. Why? A mining boom and a huge wave of migration just overpowered the rate hikes. And we don't even have to look that far back. Think about 2023. The RBA went on one of the most aggressive rate hiking cycles we've ever seen. And yeah, prices dipped for a minute. But then, from February 2023, they started climbing again. The big driver? The borders were back open, and a massive surge in migration just poured fuel back on the fire. So, if it's not all about interest rates, what really are the engines of the property market? Well, the best way to think about it is like 4 big ropes, and they're all pulling on prices at the very same time. And here they are. First, you've got interest rate policy. That's one rope for sure. But then you have the other, often much stronger ropes. The basic balance of supply and demand, the relentless pull of migration, and that super important but tricky to measure factor, confidence. Let's just zoom in on migration for a second, because this might be the most underestimated force of them all. A staggering 75% of Australia's population growth comes from people moving here from overseas. And every single one of those new arrivals needs somewhere to live, which creates this constant, powerful wave of demand. And that record-breaking demand is crashing right into a huge supply problem. The national target is to build 240,000 new homes every year. What's the reality? We're only managing about 179,000. That leaves a gap, a shortfall, of over 60,000 homes every single year. When demand is at a record high and supply is chronically low, prices really only have one way to go.
So what does this all actually mean for you right now? Well, this whole period of confusion with scary headlines about inflation and delayed rate cuts might just be what some experts call a golden window for savvy buyers. The big idea here is not to get caught up in all the short-term noise. You see, history shows that when the media is screaming about risk and other buyers get nervous and take a step back, well, that can be the moment of maximum opportunity for people who have a clear long-term plan. So the advice is pretty clear. Stop obsessing over the RBA's next move and focus on the deep fundamentals. Markets like Brisbane, Perth, and Adelaide are still showing really strong growth drivers that have almost nothing to do with interest rates. For buyers, the advice is always the same. Focus on good locations with long-term demand, and for investors, make sure you don't over-leverage yourself. And that really leaves us with the big question to think about. When you're in a market that has a deep, structural, multi-year housing shortage, and it's colliding with record-breaking population growth, are interest rates really the main story, or are they just a sideshow? We'd like to say a special thanks to Alex Sheng from Oz Property Strategy for the insights that made this explainer possible. For more deep dives just like this one, you should definitely subscribe to the Oz Property Strategy YouTube channel. And to find out more, just visit stressedpropertystrategy.com, where you can book your free discovery call. A disclaimer does apply.